Partnered by Times Influence.
Hello and welcome to our special edition, Voyage 2019. Every year, same time, we take stock of what has gone right and wrong for the year gone by and what could go right and wrong for the coming year. Frankly, last 12 months have been full of twists and turns and peak and turfs. Whatever could go right has gone right, but whatever could go wrong has also gone wrong in terms of liquidity, key assumptions, and drop in earnings. It's been a challenging year for the debt market, but it's been a promising year if you're with the right businesses, at least in the large cap stocks. But this time around, I guess the key question at the Voyage 2019 would be elections. How should one position their portfolio ahead of elections? Is election just a pit stop, or this is something which will force fund managers to do some serious rethinking about the capital allocation? So to discuss that, the three musketeers, they are back with me, Bala, Mahesh and Manish. Gentlemen, thank you for joining us, and always a pleasure to have you back. Bala, whereas election is the central theme, it is a theme which makes markets curious, it makes everyone nervous, because in 2004 there was a decline, in 2009 it was uptick. Does it make sense to really have a positioning or aggressive positioning in the run up to the election?
It's not about the positioning, it's about understanding the way forward. Clearly, the election is one which is coming in the next 1 month. I think is going to be full of news. At the end of the day, the capital market remains, the investment world remains. Investment, of course, look beyond the election outcome and what's going to be at the political development. There's a lot of action is going to be there as we move forward. Well, of course, election is one which, of course, creates some kind of curiosity. It creates some kind of volatility. It's, of course, at the expectation that how the market could move. Just to also incidentally, when we analyzed within our own team about going ahead with this Voyage investment Voyage event, which Aditya Mutual Fund has set aside as one of the key signature event of our fund house to set the direction for the future. And when we did in the year 2014, before the general election last time, we went through a similar kind of discussion, debate, what should we do, and should we do it post-election, should we do. But at the end of the day, investment world doesn't change, linking to the other election and so on and so forth, and something has to be looked at beyond the election outcome. Therefore, we said that we must go ahead and set the direction for the next 5 years. That's why we actually chose the theme as $5 trillion economy. I think how we are going to actually play in that $5 trillion economy, looking at the past as well as looking at the future, what need to be done.
Mahesh, okay, fair point. Elections don't matter. Look at market history, or 8 out of 10 times markets in the election year have gone higher. If the market verdict is not something what will excite the market, that could lead to chaos and adjustment. How does one safeguard the portfolios?
So I think there is always event risk which is there. But as you rightly said, if you look at the past, whatever, 6-7 elections, what we have seen, the outcome of the market reaction to the election result is there only in the first initial few months. After that, the market actually takes the path, okay, what it has been taking in terms of how the economy is going, how the earnings growth are going, and what's happening on the global side. So, and that will really decide the course of the market in the medium term, and that's what investors who are coming into the market are really putting their money to play, not for the next 3 months, but for the longer term. Even as portfolio managers, also difficult for us to really pay any of these kind of events. In the last 4 years, 5 years, this government has been there. We have seen a lot of policy measures which have been taken, and I mean, you don't require anything big ticket reforms, okay, which needs to be done, which is important. Okay, election or a stable political scenario is important when you want to do such kind of big reforms. So I think those big ticket reforms are behind us. It's now continuation of the policy measures, I think, which should be good enough to really sustain the economy from what we are taking out from here on. So we don't see any major reason for us to really change our portfolio allocation looking into the event. Obviously, we might keep some liquidity in our portfolio to take advantage of the volatility which will come in. But we don't see otherwise any major impact on the market irrespective of the election outcome. I think the fundamentals will follow through, and that's what has happened in the past also.
You know, for the debt market, the headline news has been good, which is that central banks, they changed their view. Crude by and large has traded in a comfort zone. Liquidity has made a comeback despite that IL&FS crisis. Yet it's been a challenging year for the debt fund managers, for the debt fund returns. Why is that?
No, broadly debt funds haven't done badly,
They've not done great with this kind of an headline, is my limited.
That's true, because the first part of the year was very volatile. Rates actually inched up, and it's been a year induced with a lot of policy volatility, which we discussed briefly. That initially RBI was tightening rates. They were trying to anchor rates at higher and higher level. They were actually guiding markets for higher term premium. And then suddenly, as the data turned, they actually turned completely, and now you are actually having rate cuts. So when you induce so much of volatility from a policymaker standpoint, the experience for the investor is a lot worse. But by and large, the people in fixed income have done reasonably well this year. So broadly, it's been a good year. But in this, of course, there've been great accidents. They've been, so unlike 2012 to 17, when banking went through mess in terms of higher and higher NPAs, MF industry did fairly well. But last 1 year, you've seen very, very largish companies actually going through trouble. Why did this happen? Is because when the liquidity choked, money wasn't made available to even good franchises. So it started with IL&FS, which potentially had a hole, but then very soon spread to many other companies, which are solvent, are good, but because they considered as shadow banks, and trust deficit actually grew in the market, and people stopped lending to them, and that's the reason it actually kind of has assumed the proportion that it has, and which is why the loan against share market has got a liquidity issues, and therefore you see a lot of loan against shares actually struggling, a lot of NBFCs actually struggling even today. Now, is there an attempt from policy making to kind of cure it? Answer to that is yes. I think the current establishment in RBI understands this well. They've actually provided a lot of liquidity. They've brought down the interest rates, and generally regulatory framework also has eased. Okay, you would have seen what happened to the FEB circular even from Supreme Court side. All of these are good news, and net would induce financial conditions would loosen, and eventually you will have improved financial conditions and improved credit conditions, so to say, for MFs also.
Are you reasonably confident that no more credit accidents will happen, especially at promoter level? Because we don't know what looks good right now may eventually turn bad. I'm just trying to understand, because you must have done risk assessment of your portfolio, the lendings which you would have.
Look, the promoter loan against shares is is being beaten up, and it's quite fashionable because it kind of it captures the imagination that as if fund managers and bankers have lent to promoters to speculate, but that's not true. In fact, that's a very small part of our portfolio, ours and NBFCs. The genuine issue that industry is facing right now is not in the loan against share market, but actually in the NBFC market. The causality of loan against share market is actually lies in NBFC stress. Who used to be the large lender to these promoters? These were the NBFCs. Now, if these NBFCs have not been provided liquidity by banking system and mutual fund, they have stopped lending to them. Either you must sell asset, or you must get refinanced. Now, selling asset is, of course, that's not the reason why promoter borrows money. It borrows money assuming that over a period of time it would create reasonable amount of assets and make money out of it. But suddenly, overnight you kind of break the system and say that I will not lend to you. All asset financing would actually get into a liquidity default. But you must understand that this liquidity default is very different from solvency default. But that's not true for a lot of promoter share backed finance, because there is a genuinely good assets and the shares are liquid, and therefore at some point in time you will get this refinance market open again.
Birla, the theme of the conference is $5 trillion, but everything will not make money. So if one works with an assumption that we are headed to 5 trillion, it's a matter of which year now. It is not a matter of the mark. We will reach the mark. It's a matter of time. Let me rephrase it. How do you propose one should invest and one can make money?
Clearly, it's the question of the when for $5 trillion economy for India to achieve. It's not the question of whether it is going to come or not. So that is being the case. I think maybe the next 5 to 7 years, and India become a $5 trillion economy. I think one fundamental relationship that exists between the capital market and the size of the economy is that the market cap is directly linked to the size of the economy, which essentially means also is a question which one has to ask ourselves. The $5 trillion economy, if it happens for India and then overall on the basis of GDP number basis, then naturally one should expect that the equity market cap also to become $5 trillion economy. So which is nothing but currently is about 2.2 or 2.3 trillion dollar. naturally that should also become fed into the economy. So, we say let us take about say 5 to 7 years time frame, and this also comes with the fact.
In 5 years, equity market should be bare double.
In about 5 I am talking about 7 years time frame, 7 to 8 years time frame, which again that's what I think ultimately should lead to. Already there is a school of thought which is going that India has to move away from developing economy to the developed economy kind of model. If that's the way I think we are going to move, definitely the investing world also will become equally challenging. In this kind of scenario, as a Aditya mutual fund being in the industry for the last 25 years, at every point of time we have a theme, and we say actually that how one should go about investing. At the end of the day, I think what has remained constant is actually the way I think one should focus on asset allocations.
Mesh, it's very simple. If we feel that today is better than yesterday and tomorrow will be better than today, then take a leap of faith. And we should not worry about a event like election or what will happen to the American economy or where crude prices are headed. Money is made by simple buy and hold. Is that the messaging at Voyage 2019? That election is crucial. It will occupy a lot of mind space, but that should not deter your financial discipline.
Yeah, and that is true if you go back in history and look at the journey in equity markets. I mean, even if you look at the last 20 years, we have seen many events, okay, where we have seen there have been big events, and we have seen market corrections also on the back of those events, and the corrections have been the tune of around 20, 30, 40%. But people who have stayed invested, okay, all throughout that period have seen their longer term returns in line with the normal returns which the equity has given. And that is true, I mean, that remains. But again, I think for India specifically at this point in time juncture where we are, we've seen a lot of pain in the last 2 years. I think India's economic growth has been lagging behind global growth, right? We've seen because of various reforms or transition which we went through, it was also reflected in the earnings growth, right? I mean, we had the world growth, developed markets like US, for example, last 2 years has seen significant earnings recovery. We haven't seen that. And we think that a lot of things are falling in place right now, though it's still been slow and gradual. We haven't seen any big cyclical upturn. And that is what I think one is looking forward over the next 5 years or so. Obviously, in the interim, you will have challenges on the global front. There have been talks about global recession coming in, global economy slowing down. I think that will weigh down and it might get recalibrated a bit. But I think there is no doubt in our mind that we are at a stage where India, at least a lot of the macro factors are falling in place. And we should see the benefit of that unfold, whether it is in the banking and financial services sector. We've seen big reforms happen over there. On the consumption side itself, I think India, I mean, has crossed now $2,000 per capita income, and we've seen that whenever economy does that, there is an inflection point in a lot of items, a lot of consumer items, where the penetration levels are low. And I think we are at the cusp of that, and that should flow through to a lot of consumer durable apparel industry, the consumer durable industry, the retailing sector, and these are sectors, okay, which could see much stronger growth. And India has also transformed, right? In the last, we have seen electricity reaching each and every village. So that has meant that a lot of consumers, individuals who were there, who are aspiring to have certain goods, but they didn't have electricity. I think we have seen that now reaching out to a lot of people. E-commerce is also reaching it out to a lot of people in the nook and corner. So all this transformation which is happening is, I think, going to benefit India, and at the same time, infrastructure, other areas would also require, right? India still requires to, while we have done a good job in the last 4-5 years, there's enough needs to be done on infrastructure side, and that pace will continue going forward. So I think all these factors, when you take into consideration, I think India has still got a long runway for to sustain growth at around 7% or so, even at a time when the global growth is kind of mildly weakening.
Birla, in Voyage 2016, when we met, the house call was go and buy equities, have a large allocation to equities. What would be the call for 12 to 18 months? I mean, what is that asset allocation call in this Voyage, considering that we are 6 weeks away from the election, mid and small cap stocks have got bruised. Money has come back, but money has come back only 10 and 15 stocks.
I think if you look at the way we have defined the whole asset allocation, when it comes to the question of investing in mutual fund, there are 4 different type of solutions are being addressed of the customer needs. One is the saving solution, and second is the income generation solution, and third is the wealth creation solution, and fourth is tax solutions. All the four different type of needs of the consumers or maybe the investors are being addressed through these four different buckets of solutions. On top of it, the mutual fund also now started offering, at especially Aditya mutual fund also now started offering solution for child education for the future, and second is for the retirement solution for the future, and both are now being offered. From the customer point of view, from the investor's point of view, all the four solutions are important. There is nothing which is I will go only with one and not with the others, and therefore, that is what I mentioned earlier, that asset allocation will play a very key role. And within that, I think as we always keep advocating all the times, the rule of course does not change, which is linked to the age minus the 100 minus the age should determine actually what should be the ideal allocation that should go in towards the equity. That formula does not change, it remains constant. And as long as you actually apply that principle and then have reasonably good exposure to equity in the form of investing at a regular interval, at the same time whatever the other surplus the one has got, to manage it through the mix of fixed income and the liquid fund, I think the large proportion of his investment needs are being met. I think that the discipline which you keep of course harping every now and then, that does not change even this year as well.
Manish, next 3, 4, 5 years, what should be expectations, and this is not guaranteed, but what should be the broad expectation from debt fund? Because 3, 4 years ago you came out with the corporate debt schemes, they give given good returns. Will that hold true going forward as well?
It's very likely, why I call it golden era of investing in fixed income is because the policymakers are standing by you, with you. They're telling you that come what may, I need to deliver real return to my fixed income investor. So the world begins at repo rate, which is supposed to be 150, 200 basis point over inflation. Then I have to give you some term premium for you to invest with me for 2 years, or 2 or 3 years, another 1%, 3.5% real rate. And on top of it, mutual funds, of course, tax efficient. It's never been so good. So while we kind of continue to look at equity market with awe, in real terms, the boom which has happened in fixed income is completely unnoticed. So I think your channel and everyone has to educate investors that here is a real platform which actually kind of gives you a solution to deliver real 2, 3, 4% real rate, and which has not happened in the history of this country.
That's a great point. I guess we underestimate what debt market can actually do. Ultimately, it's all about beating inflation. But that comes to the second point, Mahesh, which is that equity market returns are also linked to what the rate of borrowing is. In this case, if inflation remains low, could there be a challenge in your past performance? Your past performance is north of 15-18%. If the borrowing and inflation dynamics change, which they have changed permanently, is it time now to genuinely hunker down equity expectations?
Yeah, so you're right. I think as Manish mentioned,
I think playing it safe or you mean it?
No. I mean, it's all boils down to your nominal growth, right? It all flows down from the top, right? So if your lower inflation means your nominal growth will be lower than what it was in the past, right? For the same real growth. So even if a GDP growth at around 7%, if inflation is around 4% or so, it will mean nominal GDP growth of 11%. In the past, we have averaged around 12.5, 13 in that range. So clearly, I think there will be some reset in terms of top line growth by around 150 basis point or so, and to that extent that will flow down to the bottom line. So I think your earnings growth also, okay, which is the driver for the market returns in the longer term, would also be lower probably than the last 10-15 years average, which is somewhere around 13.5-14% or so, but only a tad lower, and that's fine. I think as long as even expectations of returns from the market, as long as historically we have seen, I mean, it's been around 6.5-7% than the over inflation. So if it meets that target, I think that's a good return to expect. Even in absolute term, it might be lower than the historical average, right? That's what we are looking at. So I think clearly, return expectations from the market needs to be anchored down a bit than what it was there in the last 2 decades or so, and also it's flowing in line with the overall growth what we are seeing in the Indian economy, but also how the global growth is like to pan out. But that return also would be still good return on a risk adjusted basis for investors to continue to make allocation to equities. One can argue that the near term risk reward in equity might not be as great, as Manish said that in debt also you could probably look at around 8% kind of a return. But again, equity is not about near term returns, right? Longer term risk reward I think is still very well balanced on the equity front.
Well, at a investor camp I met someone and he said the biggest mistake of his life was that he understood the magic of compounding at the age of 39. So when you look back in your career and say, look, the audience will be watching the show and the distributors would be attending Voyage, what is the one thing they need to understand? And the sooner they understand that, the better it is for them and it is better for their clients.
I think power of compounding is anyway has to be understood at every point of life in your career. I think the earlier you understand that investing for long term needs is important, I think the longer the rope that you give for any investment, the power of compounding is high. The shorter the period you give, that much of volatility that we see actually in the near term could potentially impact and make you get disappointed on such kind of outcome. I think the longer the rope if you give, definitely the outcome would be much better. That is why I think the power of compounding really works. And therefore, the planning the investment without getting too much into debate in which is the asset class I am getting in, or should I invest today or should I invest tomorrow. The biggest mistakes which I have realized, which is people generally is made, even we all have, the individual also made, that you trying to time the market, time your investment and wait for investment time to come, it never comes actually. It always, it never tells you in come, even the fall also never tells you in come. Therefore, only the way I think remain constant is actually to stay with your conviction and focus on asset allocations and make the investments in the right product among the mutual fund industries, among the 4 solution bucket which I mentioned about, and then stay invested in that. And then ultimately the power of compounding is the outcome of the time period for which you stay invested.
Birla, there is a data which says that Buffett has made 99% of its wealth after 60. You're not 60. But can I say the best of Birla is yet to come?
Yeah, naturally, of course. Naturally, we of course keep working for better the best all the time. And I am sure each year, each passing day, and given the fact that the concept of the theme itself is a $5 trillion economy, that means a lot of work to be done, a lot of hard work to be done, a lot of conviction has to be placed on the table before taking a leap of faith.
While I'm excited to associate it with Voyage for last couple of years, every time I think that we cannot raise the bar, I think we do something differently. So even though we are, celebrating Voyage 2019, I think the best of Voyage is yet to come. So on that positive note, I'll wrap the show and I look forward to meet you on the Voyage day on 24th of April. And all roads that day would be leading to the Voyage event 2019. Thank you for tuning in and thank you for watching the show.
Partnered by Times Influence.